Welcome back to the Behind the Well Show. Your host, Roger Abel, back with Elias Randall. We're kicking off 2025. What's happening? You ready for the year?
Yeah. Born ready.
I came in here this morning and I started talking to Molly about all my ambitions and things I wanted to do. I didn't set any hard resolutions this year. I'm following your lead.
Good.
Although I do have some goals I want to accomplish, and it's funny. I told Molly one of the things that I wanted to do, and she goes, well, I'll pull that list out from 3 years ago when you asked for that then, and I didn't execute it. So it's going to get executed this year.
Whoa.
And you're actually involved.
Good.
So I told Molly, I'm not very good at joining industry groups, but I feel it's probably important for us to do it this year. So we're going to get to join some
You're going to
industry.
join some groups.
Well, so are you. Because I said, I'm going to join too, and she said, so is Elias.
So you know what the great thing is? When you set your expectations and you set your goals, you aim low. When you aim low, you know what happens?
You always accomplish it.
You avoid disappointment.
Didn't I teach you that like several years ago? Remember I told you, I always tell you how I always just expect when I go on vacation, just going to be a mess, just total disaster. So that if it is, like that was the expectation, it's better. Yeah. Great. We just got back from Disney. So
fun. My
expectation was this is just going to be total chaos, like total you-know-what show. No, it was great.
Was it really?
Yeah, we had a really great
fun.
time.
The pictures I saw looked really fun.
I was expecting, so we stayed on Disney resorts. I was expecting, like the traditional Disney room, which is okay. Oh no, this was really nice. We stayed at the Contemporary. It was all new and refinished and actually pretty big. And we had a little slider walkout patio that we could go out to and watch the little fireworks at night. I told my wife, I'm like, you did really great. Because she
that's the
it
thing. Like, especially if Disney can be very expensive, but they do make it a great experience. They kind of go over the top on all the details and the food, and even just to go out on your balcony and watch fireworks every night. Kids love that kind of stuff.
So
you pay for it, but
this is our second time, so I already knew what the expectation was. The first time I went, and we went to the character brunch, or the first night we did a character like buffet. And I got the bill for $340 for 2 kids and 2 adults. I'm like, oh my God. Because I was
kids that ate 3 bites of food because all the princesses are there and they're not hungry because they're too excited.
So the first time I went was like sticker shock. Well, this time I went and I was able to budget and kind of said, okay, I know what this is going to be now. So I fully expected it. It was way more enjoyable. I feel bad for the people that don't actually know what they're getting involved with when they go there.
Oh, I'm sure you can ruin a vacation pretty quick if you're not prepared for all the extra expense.
Okay, here's the second thing that is interesting. So the last time I went would have been 2022. And I thought it was really expensive, right? This time, I thought it was expensive, but not really expensive. And let me preface why. I feel like inflation's happened all these other places, but they haven't drastically inflated their price.
Well, maybe they can't. Consumers might not be able to pay if
I was paying $9.50 for a beer. Well, that's not cheap. That's not crazy. Go to a concert or a sporting event, it's $20.
Yeah. And
you're on a Disney resort. The resort we were at, I got a kid's meal for $9. It was a burger, fries, fruit, and a drink. I'm not sure I could go to McDonald's for $9. So when I walked away, when we weren't at like a character event, I told my wife, I'm like, I actually don't think this is that unreasonable, because I think a lot of other places have raised their prices and they've actually stayed fairly status quo on their price. I'm not saying by any means it's a bargain, but I was in Miami last year. South Beach, Florida, way more expensive than Disney.
Is it really?
Oh, we were on South Beach and we stayed at the Lowe's Hotel, maybe, I think. I don't remember the name of it. It was like $27 for a cocktail.
Whoa.
27?
$27?
$27. Well, I went to JW Marriott with LPL last spring for a kid's virgin pina colada, $13. So sugar water with ice, $13.
Should have just got it with the alcohol in a sidecar, so then you could have at least drink the shot.
That's what they did. They were charging you for the actual alcoholic beverage without the alcohol.
Yeah.
And I'm sure it was for simplicity. But either way, you're right. If you set your expectations low, it's really hard to underperform. I mean, you have to be really bad if you set your expectations that low.
Well, so do you know where I got that?
For me, I taught this to you like years ago.
That's part of it, but the actual quote. So someone sent me a calendar of every day has a motivational quote, and it was the calendar on my desk. So I'd, ripping them off and throwing them away every day. And I kept one because randomly in the whole thing, there's all these motivational quotes. And then there's one that basically says, aim low, keep your goals low, and avoid disappointment. So I think it was a joke. I think it was put in there to be funny in the whole calendar pack. And I probably had this in 2021. It's still hanging up on my desk because I think it's funny.
Okay, so it actually leads me into one of the topics I wanted to talk about today, and I'll pose the question to you. Every year, analysts, strategists, for basically all the major investment banks, companies out there give their predictions for the market. And generally, they're wrong. I mean, these are totally irrelevant. They're typically not going to come to fruition. Nobody knows what the stock market's going to do. And a couple examples. I had an individual come in my office 1 year ago to about today, sat in my office and said, I think we should sell everything and go to all cash because I know the stock market's going down. The exact words. And the wife was next to him and the wife's like, okay, sure. I go, how do you know? And he listed off like 4 events that were going to happen, that whether they did happen or not, I don't even remember what they were. He said it was going down. Like he knew it was going down. And I convinced him, hey, look, we don't know. I don't know. The analysts don't know. You don't know. YouTube doesn't know. Nobody knows, right? I convinced him to stay invested. We used some protection strategies to kind of overcome those fears. Stock market was up 23% in 2024. But expectations, let's move on from that and talk about investment banks. Do you think they make predictions that are on the low side so people don't disappoint? And I'm going to throw the first one out there. Mike Wilson from Morgan Stanley, he's like one of their top analysts, predicted a flat market in 2024 with it ending at 4,500.
I would say in general, yes. I have felt that way a long time, that a lot of analysts, they would rather miss the mark below it than above it, because I don't think anyone wants to seem overly aggressive in their forecast. So, which, predictions are pretty dangerous because basically almost everyone was wrong about 2024.
Yes, who wasn't wrong?
Consensus was pretty close to what you just said, like 45 to 40, maybe 5. I think I remember reading something at the end of 2023 that the most bullish prediction of the market in 2024 was like at 5,400 on the S&P 500.
Let's see. What did Tom Lee forecast? Typically, Tom Lee is the perma bull.
And he's not always correct. His forecasts do tend to be, it seems like he's more accurate than other analysts and forecasters.
Guess what he predicted for 2024? 20% gain.
So he was close.
He was there.
He was close.
But here's what gets me. So I'm going to go back and read a few more because this is all about expectations. And I'm trying to figure out if they're trying to just lower the expectation or they just, when things go bad, want to be right. Because if you think about what gets clicks and what gets followers and all that stuff, it's when you're right on a prediction. Like Michael Burry, right about the great financial crisis. Okay, that was 2009. For the last 15 years, he's been wrong. I mean, he told people the market's crashing. Harry Dent, right one time about Japan 25 years ago.
Yeah.
Still not right. Let's see who else we got. Oppenheimer. They said had a year-end target, 5,500. So they actually had decent upside. Trying to see who else is on here. But for the most part, most people or most analysts in 2024 were not expecting 20+% gains. So it just goes to show whatever people are talking about for this year, it's probably not right. We don't know what it's going to do.
Well, some of them could be right.
Somebody will be right.
Yeah.
Someone will be right. Like I was thinking about the person who came in and told me the stock market was going down. Well, if he came in again this year, 1 year to the date, and said the stock market's going down, he's actually getting closer to being correct.
Well, yeah, if you say it every year, eventually you'll be right.
There you go. Eventually you're going to be right. If you keep predicting it.
Here's the other thing that I think is especially for investors, when you start to make decisions based on predictions and outlooks. So let's say you were following analyst and their year-end price target was 4,800 on the S&P 500 for the end of 2024. And when the market was down in 2022, maybe you were buying more equities or more stock market at that time. And then on the way back up, you rebalanced because you thought we were at end of the year target. Well, now you rebalance into a more conservative portfolio because you thought we were on the high end of the trading range, as opposed to maybe thinking we're kind of at the beginning of a bull market and it's going to keep going. You could have missed out on a lot of gains just by making a decision based on that. And whether that decision should really be made probably more with, are you going to need to spend any of this money in the next 1 year, 2 years, 3 years, right? Every investor is different where they're at and what they need the money to do. But it's easy to make mistakes when you're making decisions based on predictions for what's going to happen in the next 12 months.
It goes back to two things. It goes back to one, what's the time horizon? Then doesn't matter for your time horizon. I mean, if this is growth money, why does it matter what the stock market does this year? History shows us you can't time it, so it doesn't matter. You hit it on the head. If you need this money, then it shouldn't be in the market anyway, so it's irrelevant. So good financial plan, a distribution strategy if you're in retirement, and take a good reflection as to what your time horizon is. Nationwide released this chart. I don't know if you have it, and hopefully Molly can put this up on the screen for the viewers, that took a look at average expected calendar year returns. Okay, so that was what was expected by the analysts. The difference between the expected return and the actual return. So for calendar year 2024, consensus stock market return was 2%. Market was up 24. But let me go read, basically going back to, let's just call it 08, okay? Consensus returns. Actually, let's go back to 2000. I have 2000. The consensus, analyst return was 0%. Market was up 7. For 2001, analysts expected 19%. Market was down 27. 2002, analysts expected 13. Market was down 32. They're never right. And after the early 2000s, almost every single consensus stock market return by an analyst is less than 8%. There's only been 1 year since 2004 that analysts have had a consensus of over 8%, and that was 2019. It looks like they expected a 19% return. Every other year, 2020, 3%, 21, 7. I mean, every year they are wrong. They're not even close to right. The closest year they've ever been to being right was 2004. They expected 7. The market expected 2. The market did 7. But typically, if I look at the dot plots here, the market's significantly higher than what the consensus is. And here's the other really ironic thing. Whenever, I won't say whenever, but on this chart, anytime, most of the time they've had double-digit returns, the market is either flat or negative. There's only one time that they had a double-digit expected return that it was actually up over. One time is up 9%. The other two is negative 27, negative 32, up 1.
Yeah, that
so
is
if they get
interesting.
bullish, if the analysts get bullish, I'm not sure that's a great sign for the market.
And it's that is interesting. Here's what I think it is. I think it's if I set my outlook at this and I'm wrong and it's more than what I set my out, no one's going to be upset with me for being wrong and it's better than expected.
So I have a question. If the last 60 years, the average has been 10%, don't you just put it at 10%?
You'd be a lot closer. You'd be a lot closer to being right if you did that.
If they set their target at 9% every year, they would be closer to being right than being wrong. And if, as an individual investor, if you just set your expectation that over the long term I'm going to average 9 or 10%, guess what will probably happen?
That.
Well,
for your growth money anyway.
All right, let's take a look at the last 4 years. Okay. So everybody's on high, market's done great. Well, if I take the return since 2021, up 26, down 20, so we're 6%, up 24, up 23. So we have a gross return of 53% over 4 years. Well, guess where we're at? Yeah, about 12, 13% a year. Like, it's going to come back. Reversion to the mean. If we make 20 a few years, eventually it's not going to be 20. It could be it for a long period of time, but then you'll have a correction that brings it back to what's reality.
Right. It can get excessive, right? Like 2021, that's a good example. I mean, the market got so high where like it's hard to value that price, right? When you look at the earnings of all the companies.
Here's what's crazy. Here's the 2019, the market was up 28, 19 up 16, 2019 up 28, 2020 up 16, 21, 26, down 19, up 24, up 23. There hasn't been a year, except for 2022, the market's returned less than 15%.
Well, and you hear people say, well, but if you could time that exactly right every single time, think what would happen.
Guess what timing it was?
But
just
you need
buy it in 2019 and don't ever look again.
Right, but there are people out there that make the argument that you should be able to time the market
with all your grand wisdom.
Because if you do it right, well, if I sell at the right time and buy at the right time, what would my result be?
I think predicting stock markets is one thing, but now we're also trying to not predict returns of the stock market, but all these analysts and bond traders are trying to predict inflation. And it's kind of weighing on the stock market a little bit. But at the same time, I think people are fearful as they've watched, the overnight lending rate, the Fed's fund rate get lowered. But mortgage rates are back over 7%. Interest rates are actually going up while they're going down. It's ironic. And I don't think people understand the difference of how things are actually priced. And I think there is a worry that, hey, we're going to have inflation, which is ironic because we didn't worry about inflation for 20 some years. But now that we've had it, there's recency bias and we're going to have inflation if we do this.
So I think there definitely is an argument for the sticky inflation as people have been talking about and inflation being persistent. Here's where I have a hard time getting behind that. If we're going to have consumers have to be able to still buy the goods. And if consumers, there's less just money out there. I mean, not less money in the economy, but less spending money available for individual consumers now. So it's hard to me, it's hard to predict that, yeah, we're going to continue having this inflation when if people don't have the money to actually spend, how can you afford the new higher prices? And how do the prices continue going up if people can't buy the goods?
Well, and I think what's really happened is I feel like we have two economies right now. I really do.
Okay. What are those two?
I think, and this goes back to my conversation with my friend at the hunting lodge. So one of the guys that came into the group, he's involved in real estate and stuff out of state. And he was talking to this individual saying, hey, you know what? People are tapped out. They're out of money. Like, people are struggling. And I said the same thing. I'm like, credit card debt just hit $1 trillion. Delinquencies are up, like people are out of money. He goes, but I just don't see that. The other gentleman I'm talking to. He goes, I just don't see that. I said, well, yeah, I believe that. Because people who have owned assets over the last 4 years have done exceptionally well. I said, you own a business, you have stock market investments, you own land, you own real estate, like you're in the top 1% of wealth in the world.
Inflation is not bad for those people.
Inflation's great for those people because it inflates the prices, and typically they have very low debt. He's a non-leveraged guy. He doesn't have any debt. So it's good for him.
Yeah, so all of his real estate assets went up in value.
Everything went up.
His stock market portfolio's done well. His business can charge higher prices now.
And that's what I told him. I said, so you're right. You don't see that. I said, there is a whole nother side of this economy where people can barely afford the stuff. Car insurance, homeowners insurance, the cost to own a home. What was it? 2 months ago, I saw the statistic, first-time home buyer, average age, 38 years old.
Is that high?
For a first-time home buyer?
That's where the average age is at now.
When did you buy your first house?
What did that used to be?
I'm not sure, but when did you buy your first house?
It was like 23.
I bought my first house at 23. So think about, for most Americans, the two biggest ways they build wealth is their house and their 401k, and that's about it.
Yeah.
Most people don't take money and go, hopefully listeners to this show do, but the vast majority of the population, they do their 401k and they own a home. They might have some savings in the bank. They're not out opening a brokerage account. They're not buying rental real estate. They're not maxing out Roth IRAs. They're just doing their 401k and they own a house. So most of their wealth is concentrated in those two places. Well, if you remove one of the massive wealth building tools for people, what happens?
You're saying if you remove their home?
Yeah, like now instead of buying that house at 23, you buy it at 38.
Oh, well.
It's 15 years of wealth building.
Yeah, right.
And it's leveraged wealth building, right? You bought the house for $150,000.
You'll have debt longer too, most likely.
They're never going to pay it off. If you buy a house at 38, you're never going to pay it off.
Well, when you're 68 on a 30-year mortgage.
No, it's not reality. Here's why. How many people stay in their starter home forever? This is their first home.
Not a lot.
And then so they stay there for 5 years. Now they're 43. What happens next? They buy another house.
Go get a bigger one.
Bigger house.
More bigger.
How long
more
was the
bigger,
mortgage?
more better.
How long was the mortgage? 30 years. They don't say,
no,
hey.
they're doing a 15. Yeah, probably 30 years.
They should do a 15, but they're not.
Yeah.
Everybody keeps
or do a 30 and extra payments or
right.
whatever.
Okay.
But yeah.
And now
they
hear me out. So now they bought this house at 43. They bought it this year, 43. They took a 6.875% rate. It's about what it is, 30-year. Well, in 5 years, if interest rates go back and they can refinance that mortgage at 5%, what are they going to do? They're going to refinance it for 5% for another 30 years.
Right, and have better cash, month-to-month cash
They're
flow.
never going to pay it off. So there's the two sides of the economy. You have this one economy that's thriving with people who own assets, investments, businesses. In the last 4 years, people who don't have assets have not done well.
And there's a lot more wealthy people now than there were certainly 50, 60, and 70 years ago.
I don't know if that's true or not. I don't know that. I don't know if there are more people.
I guess I'm assuming that. Just the economy's bigger. There's more money. There's more businesses.
I think the number is clearly higher, but is the percentage higher? I don't know. Or is
I
it
guess,
just,
yeah, I don't know either.
it could just
But
be,
even if the percentage is not higher, there's still just more.
but it also means there's more people doing worse. You remember my banker friend? He's like, man, I just don't know how my kid's ever going to buy a house. It's expensive. And what is the youngest generation in America addicted to? Buying things. Okay. When I was in high school, going to Burger King for lunch was a big deal. Right? Like that was
Burger King was
$2.
a big deal.
Hey, Little Caesars, $2, slice and a pop. You remember that? Did you do that? You probably didn't have that in Grundy Center.
No, where I grew up, we didn't have chain restaurants.
Little Caesars, you could go there and get a slice of pizza and a drink for $2. So
Okay,
everybody
so
from high school would be there, right?
We would go to Casey's.
What's the new Little Caesars?
The
Chick-fil-A.
gas station?
It's Chick-fil-A.
Oh, Chick-fil-A.
It's $30. Poncheros Brews, $15. That's without a drink.
Well,
all their money's getting spent.
Quit going to
But they
Poncheros
won't.
and Chick-fil-A.
Starbucks.
Quit going.
Okay. Let's talk about prices. Starbucks, if I go to Starbucks and get a large coffee for myself and a large Americano for my wife, it's about $9. Guess what 2 large coffees was at a Disney resort?
$9.
$7.82. I told my wife, I'm like, this is cheaper than Starbucks. And I'm in the resort buying Joffrey's coffee.
Well, at least they don't gouge you on your coffee.
I felt like I was getting a deal every single day. But people are still worried about inflation. I think especially that we have a new administration coming in and some of the proposed tariffs, people feel as if they will be inflationary. I think that's yet to be determined. I think one thing that we've learned is just because we think interest rates are going up or going down, we really don't know. It's just like the stock market. I mean, there's a little bit more predictability in the short-term interest rates because the Federal Reserve and Jerome Powell shed some guidance on that. But the 10-year yield on the 10-year Treasury, which is what prices mortgages in September, was like 3.6%. It's 4.7 today. So interest rates are down. Short-term interest rates are down. Fed funds rates down 1%, which helps. Home equity line of credit, car loans, your credit card, all that stuff. It helps that. Those rates are down 1. Mortgage rates are up 1.
Right, which is probably that's an indicator, or that's because people are thinking there's going to be inflation.
Well, no, it's really because the 10-year yield is what prices mortgages. Bond traders are expecting.
I know, but the reason the yield has gone up is because of expected inflation.
Correct.
Right?
That's a pretty big move when interest rates are actually coming down.
Right, so that's a pretty big, I guess that's a big bet too by
I think it's going to be
there will be inflation.
I think it'll be the story of 2025. What does inflation
actually do? Is that your prediction?
I'm not predicting. I just think it'll be a story because it doesn't matter what side you're on, whether you think rates are coming down or coming up, someone's going to be right. If they go higher, it's going to be a big story, right?
Yeah.
Like if we get big inflation, it's going to be a big story. And if rates come down drastically, let's say these tariffs happen, but we don't get a bunch of inflation, it'll still be a big story. But I think it's going to be a driving headline for 2025 is inflation and interest rates.
Oh,
I was watching, is it Patrick Bet David? Do you know who he is?
I've seen his videos.
They were talking on one of his videos. I think I just watched it 2 days ago. About the amount of pressure that the new administration is going to put on Jerome Powell.
They might put pressure, but the Fed's supposed to operate independently.
You'd think
I guess they could fire him.
Elias, the Prime Minister of Canada, they put pressure on him too.
Yeah,
he just resigned.
I saw that.
You can only handle pressure so long. So it's going to be really interesting to see what's really going to happen this year. How much is talk? How much is reality of what's going to happen? But I think the Federal Reserve is going to get a ton of pressure.
Very possible.
So it'll be interesting to see what happens. As we go through the years, we're kind of talking about predictions. In full disclosure, we don't predict.
I feel like you just made 2 predictions.
What? What are my predictions?
That inflation and interest rates would be a big story of 2025.
Okay, it's going to be a big story
the Federal
either way.
Reserve is going to get a lot of pressure. Those seem like predictions.
Well, yeah, I mean, but I didn't predict one way or the other. I just predicted that I think these things will happen. I'm not picking a side because over time, I've realized I can't predict any better than anybody else. I just feel like those two things will drive markets in 2025. Interest rates are going to drive markets.
Probably fairly solid predictions.
I mean, if you just look at the housing market, it's still locked up.
Yeah.
There's not much inventory, and sellers are not lowering their price. You know,
They're not going to.
Look at all the predictions in 2024. You could go on any YouTube, stock market's going to crash. Or, I mean, not stock market, but housing market's going to crash. And there are places prices are coming down. But for the vast majority of real estate, prices are not coming down that much. Maybe a little bit. But what someone's asking and what's they're going to get are two different things. There's people out there that just put hey, this is what I would sell it for number. And if I don't care. Like, they're not serious sellers.
But I think there's a lot of people in that mentality now.
Yeah, but those aren't selling.
Because why would you? Right, but if you
they don't want to sell.
If you live in a neighborhood and 2 years ago your neighbor sold a house for 10 or 15% more than, right? You're not gonna market your house for 10, 15% less than your neighbor did 2 years ago.
That's not what's happening. They're marketing their house for 25% more than what their neighbor bought it. That's not what,
right.
If they were marketing
and that's not
for
a serious selling price. That's just, because that's probably the number that then they can go and get the house they really want now.
There you go. That's why this is tied up. There's a piece of land my wife would like to buy to build a house. They paid an amount in 2021 or 22. They want 80% more than what they paid 18 months later.
Yeah, they just want to see if someone will buy it.
It's been for sale. For 185 days, roughly. And I have my real estate agent reach out. And they're like, no, they're not going to sell it for less. And my real estate agent said, well, okay, call us in the spring when it's been on the market for another 90 days. And on Zillow, you can gauge interest of how popular property is because it'll show you how many saves or likes. So like a really hot property, it could get 50 to 100 saves or likes in the first 7 days. This has been on the market for 185 days, has 7.
Yeah, and all 7 people are waiting for the price to come down.
Well, I'm one of them. So there's really 6.
Yeah.
And the others are probably real estate agents. But I think that's part of the problem is people still think they can ask 50% more 18 months. They think they just buy this stuff and it goes up. And it's just not reality. It doesn't mean it's going down in price. Just means it's not drastically increasing from where it was. Yeah. With that said, I'm looking forward to 2025. I hope that the people who are listening to this show, watching this show, send us some questions at btwellshow.com if you want us to answer those. If there's some content you guys would like to hear about, we'd be happy to discuss. I'm looking forward to 2025 with no predictions, low expectations. So we can't underperform those, Elias. Do you have any closing thoughts?
There you go. Set your sights low and avoid disappointment. It's a good mode of operation.
Now we set our sights high, as you know. But at the end of the day, I think we're gonna have a great year. Hopefully the stock market has a good year. Hopefully all of our listeners and subscribers have a great year as well. With that said, I want to thank everybody. Have a great day.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk.
Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs and does not assure profit or protect against loss.
All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. Consult your tax professional about eligibility to Roth and traditional IRA contributions. Contributions and earnings in a Roth IRA can be withdrawn without paying taxes and penalties if the account owner is at least 59.5 and has held their Roth IRA for at least 5 years.
Traditional IRA account owners have considerations to make before performing a Roth IRA conversion.
These primarily include income tax consequences on the converted amount in the year of the conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a minimum distribution, R&D, in the year you convert, you must do so before converting to a Roth IRA. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor